How's everybody
Hi.
doing?
Hi, Chastity. Hi, Jackie.
Hello.
All right. So as we,
So, Jackie, what's the
yeah,
one pick today?
What's the what? The hot pick?
The hot pick today.
You have to stay on to the end to find out.
yeah, right. All right. So we're actually going to make sure that everybody's on mute except for our speaker. And there's still some more people filtering in. So my name is Chastity Navarro. I'm the events manager at the Boca Chamber. Welcome to another virtual event brought to you by the Boca Chamber. We're very excited to have our speaker with us today. She's going to be discussing where are we and what's next, stock market insights. So before we introduce our speaker, Sophia's going to go over a quick little Zoom tutorial for those of you who are newbies. Sophia?
Hi, everybody. Welcome. This is going to be a very interactive presentation. So in order to ask your questions or, make comments, you're going to do it in the chat box. And to do that, on the bottom of your Zoom screen, there's going to be a chat box option. If you click that, a little thing will come up. And actually, I'm going to send a message to everyone now. And everyone should have received a message from me in the chat box. And then we're also going to be doing polls throughout the presentation. So if you see questions pop up on your screen, please answer those questions in the chat box as well. Thanks.
Awesome. Thanks, Sophia. So just remember, any questions that you may have or you want to direct them to Jackie Reeves, just type them in the chat box. If you don't want everybody to see your question, you can actually scroll on the little caret down arrow and just select Jackie. So I'm going to introduce our speaker. Jackie Reeves is a managing director of Bell Rock Capital. She has the firm's research and portfolio strategy group. At Bell Rock, we focus on building wealth for individuals and families, as well as 401k advisory services, including ongoing monitoring of investments and employee education. Ms. Reeves is a resource to the national media, including CNBC, Bloomberg Television, and radio, the Wall Street Journal, Business Week, and various other printed media. Their mission is to deliver returns consistent with client goals. Jackie Reeves serves as a trustee, board member with the YMCA of South Palm Beach County. She's chair-elect of the Greater Boca Raton Chamber of Commerce Board of Director, a 2013 Diamond Award recipient, a 2010 recipient of the Chairman's Award, and chaired the 2011 Leadership Boca class. Jackie volunteers with the George Snow Scholarship Fund and the Junior League of Boca Raton. Ms. Reeves was a Seroptimus Award recipient in 2013 and a Woman Volunteer of the Year nominee of the Junior League of Boca Raton in 2017. Jackie is a past president of the Junior League of Boca Raton, the Junior League of Boca Raton Endowment Fund, and Spirit of Giving Network. Jackie Reeves holds the AIFA and the PPM designations. The AIFA designation certifies that the recipient has advanced knowledge of fiduciary standards of care, their applications to the investment management process, and procedures for assessing conformance by third parties to fiduciary standards. The PPC designation certifies that the recipient has specialized knowledge of retirement plan compliance requirements, common plan services, and plan administration. Jackie Reeves has an insane bio, but she missed one thing. She was also a rock star of the Stilettos. She was a keyboardist for Golden Bell the Vans of 2019. So without you, Miss Jackie Reeves.
Thank you. I do have that terrific photo too, so I'll have to share that maybe at the end. Thank you all for being here this afternoon. And I do want to give a big shout out to our first responders and frontline people. I am just so thankful they're out there helping each and every one of us every day. And I hope all of you are healthy and safe as well. So I'm happy to say we do have a question right off the bat, which I'm really excited about. I have asked our chamber team to sprinkle out some questions while I'm going through kind of my opening comments about the markets and how we believe we got where we are, because there's a lot of moving parts beyond the main attraction, which is obviously COVID-19, that I want to describe because it does impact different areas of the markets, as well as will impact where we even are in terms of stability and then going forward. So first and foremost, thank you, Beth, for asking, will the markets react based on the order the states open up? So I'll have to say that good news, from all of this is that I am hearing literally over the last 48 hours about more, in fact, last night, some of the Midwest states looking at opening up various factories, various businesses. So those are great seeds for all of us to look to, number one, for more information about how to execute that locally. And then I do believe that the states and the markets, if you will be reacting. And so that's a good word to use because it will be volatile, both up and down, with respect to how successful all of this is with one state versus another state and how they're doing. And our learning curve is extremely steep during this process. And thankfully, I'll just say, I know we're all up to the task of executing it as flawlessly as we possibly can. And so, today we're having a bit of a down day, not like we've seen over the course of literally just the last 4 weeks, if you can think about it as the amount of information and the amount of change that we have all absorbed over the last 4 weeks is unprecedented. And that's partially due to the fact that earnings for the first quarter just started in earnest yesterday. And, we all believe we know what's going to be happening as it's coming out. And the banks, as well as other companies, have been very, very vocal about this quarter's earnings season is going to be very, very challenging. And I'll get into more about why I also think that's going to have some seeds of opportunity and also clarity, if you will, with respect to why some of the CEOs and CFOs can probably comment a little bit more liberally. But let me just take a step back and just say that we are in a period of daily, if not hourly, information, which is very different than our norm. And there's a lot to digest in a short amount of time. So I also want to encourage everybody to keep asking questions as we're going, because I certainly don't want this, or I want it to be as less an outbound flow of information and to start incorporating more of a conversation. But we started and we're continuing to be in a period in which monetary policy is still doing the lion's share of the heavy lifting to keep our economy moving and to keep the stock markets moving. And so in an emergency session, just to kind of put this in perspective, the Fed cut interest rates to 0 only a month ago. So on Sunday, March 15th, emergency session, boom, moving everything to 0. Quantitative easing, $700 billion of asset purchases, treasuries, mortgage-backed securities. Then in the following weeks, the Treasury announced unlimited, crazy buying power, government securities, muni bonds, corporate bonds, plus direct lending to small businesses. So this is unprecedented monetary easing, and we need it. So that's the part that I want to try and help bring some clarity to why that all is happening. And so I'm just going to take a quick look. So forgive me for the questions are coming in, which I'm really thankful for. When you can work this in. Thank you. And I'm concerned about the money the Fed is printing, long-term kind of inflation. So let's just keep that in our forefront. How does all this impact on the international side? And then also, what does this mean for, the next iteration of inflation to come? And those are very good questions. So on the fiscal side, so now we have the monetary side of the house, heavy lifting, still doing the heavy lifting. The primary reason is because the fiscal side, which we've started to see, the tax filing deadline right today, but it's been extended out to July 17th. That's great. No penalties, no interest. We don't have to worry about that right now. So thankfully, some people that maybe were getting money back, they've already submitted. Then the second major portion was the $2 trillion CARES package for America. So this is coming, but it's kind of almost like a steamroller in that we know it's coming. It's been approved for what seems like an eternity now, even though it's a short amount of time. Checks to Americans. I know some people have received them. Enhanced unemployment insurance, hundreds of billions of dollars in emergency loans to small businesses, resources to hospitals, medical equipment. Also on the other side, if any companies are starting to take money, we've seen a big suspension of buybacks. That just makes a whole lot of sense. And then 150 billion or so to states and local municipalities, 55 billion to the healthcare system, 10 billion more to small business emergency grants, 30 billion to emergency education funding. So you get the idea here. This is actually mounting more closer to 3 trillion in the aggregate, but the majority of these funds have not really been received. I've definitely heard a lot of great commentary from small businesses, from individuals that literally over the last 48 hours, they've received checks in their bank accounts, which is awesome. I know from my network of community banks and regional banks across the country that over the next 72 hours, we are going to have a lot more of this funding in the hands of the Americans, the small businesses, and that is critical to our economy and to the recovery, because as slowly as we have stalled, or as quickly as we have stalled the economy, the slowness of the funds to get there just keeps everybody obviously on edge, in addition to obviously having to deal with the health crisis. Now, the major difference this time around versus 2008, I'll just quantify that, is that there is absolutely no debate that we need the government intervention. In 2008, there was a whole lot of whose fault is this? Why are we bailing them out? They're the ones that created this problem. 2020, no doubt about it, we need support and we need it quick, and we need almost unlimited power to execute this. So at this point, I'm going to ask also that we kind of send out the next question, if you will. And yeah, so we have some questions here about, is it a V, is it a U? The interesting thing is we've technically already have seen a V. And I realized I'm trying to multitask here, and obviously anybody that's doing this knows that there's probably not enough fingers to keep everything migrating. But the next part of the discussion clearly is the COVID-19 problem rocking the world. The stock market and bond markets have also been dealing with a problem as a byproduct, I'll call it, of the oil crisis and feud between Saudi Arabia and Russia. So oil was already an issue, I'll say probably from January through the beginning of March. So was COVID, we just all didn't know about it. And then what happened, it was roughly, March 7th, oil production skyrockets kind of that week. Oil prices plunge. And then this causes dramatic US Treasury debt volatility. And kind of why do we care about that? Because we care about that because it is typically an underlying hedge instrument for many trading desks around the globe, frankly, but particularly here in the US. And that's just extremely important as it starts to impact other things. Oh, I got a question here. The question polls are not working for me. Okay, thank you, Sophia. And then, so what happens here is that we have oil prices skyrocket. The production skyrockets, prices plunge. Now there's trading desks all across the US and globally that are caught in a hedge position that they're on the wrong side. So they need to try and unwind all of these massive trades that are kind of just, if you picture it, they're kind of just stacked upon one another. And US Treasury debt is a very secure instrument. So you can leverage Treasury debt pretty substantially because of the safety and soundness of it. That being said, it moved in like 20 to 30% price fluctuations during most of March, which then wreaked havoc on fixed income and all the leverage that was built on top of that, to the point where there were margin calls and all these companies and organizations had to unwind those trades. So the first layer that we saw affected by this was Treasury bonds, muni bonds, and corporate bonds. The liquidity in those sectors just completely dried up. And that is why it was so important for the Treasury Department to come in and step by step provide that liquidity needed for the bond markets en masse to provide that liquidity, because technically there wasn't anything wrong with the underlying credit of those institutions or that paper. There was a lack of liquidity, and that needed to be stemmed there. And then after that, sorry, didn't mute my phone. After that, so once you're trying to actually sell and build liquidity for your own company, if you no longer have the liquidity in those markets, the next thing that happens is you go to equities and you start selling over there to shore up equity within your company and raise that capital. So that entire massive amount of volume really crescendoed, in our view, in late March, when you saw the VIX, which is a measure of volatility for the markets, hit it all-time high in the high 80s. And just to quantify that, the normal trading range for the VIX is between 12 and 20. So high 80s, I mean, it was right up there and even a little bit higher than what we saw during the 2008 Great Recession. And so since then, the stock and bond markets, because of all the massive, unprecedented liquidity coming from the Treasury, they are forming a base. But these are all interconnected with the oil markets. So the oil industry is experiencing a shock supply on supply side as well as the demand side. And from our perspective, this oil war, if you will, just really needs to be shut down. And this is beginning in earnest kind of over the last several days. Just looking through here some questions. And then on the screen, you'll just see kind of who are we. I know I see many of you at the chamber functions and obviously out and about in the community. Some people probably have no idea what I really do. So I just thought it would be a really good idea to show some slides here in terms of what we do and who our team is. We do have offices throughout the country. And I just want to get quickly to kind of, we do all of our own research. So we do a stock and bond buying for portfolios. And it's really a bottoms up type of analysis. And then this is the page that I really want to spend most of the time on. And it just goes through the bullets in terms of how I'm going to address what's happening here in the market. So as I finish here with oil, while we're not finished, generally speaking, because even the cuts that have been announced thus far, they kind of total, through some fuzzy math, about 20 million barrels per day. But from all the research I've done, that still means, based on obviously the demand side shrinking, that we're still in an oversupply situation. And to illustrate this even further, the tankers in the sea, as well as the tanks on land, are going for premium prices because they're pumping so much oil that there's nowhere to put it. So it's just an incredible situation. So I almost think that, at some point, both Russia and Saudi Arabia are going to have to come to grips with. If we just keep pumping it out, eventually we're just going to saturate every possible nook and cranny around the entire world that we can store this oil supply. Nonetheless, that over time that will correct. But I do also have to share with you that in my own research, Russia and even Saudi Arabia to a certain extent have been building up their country balance sheets to potentially, like we're doing here, be able to absorb the low oil prices for a sustained period of time. And when I say sustained period of time, in all of my readings, what that has meant is nearly a decade. So that is kind of the chest of monetary strength of their balance sheets that they could potentially weather this storm. So let's see, what are the limits? So I am seeing some questions. Hopefully I'll be able to answer most of them. And I'm not sure, based on the audience, if at some point we also might not want to just open some people up so we can start having also a conversation about all of this. Generally speaking, once the credit markets are restored to some of their normalcy, which I'll say I am seeing. So let me put that in perspective with numbers. When all of this started to crack the markets on the bond side, I was seeing AAA credit rating bonds, fortress institutions, even through all of this. They were trading at nearly 40% discounts to what they were trading just a few days prior to that. So the yield to call types of returns over the next 6 to 9 months was extraordinary, 30+%. So that's the type of thing that I'm talking about, that's restoring to some sort of normalcy. And also the equity markets will return to normal trading. And what I mean by that specifically is not that we'll go back to the highs that we saw in January. That's not it. It's more about that volatility index. We're certainly off the high of 80s that we saw in March. And now we're kind of upper 30s, lower 40s, better, but not yet normal. And as we move through that, that'll be, we'll see that obviously as more successes and we open up the economy. Now, there's a lot of questions or thoughts with respect to, yes, this or extraordinary Fed stimulus, what happens after this, and we can kind of get to that later in the conversation, but we ultimately will be wrestling with how do we exit the stimulus? How do we bring all this back in? In the meantime, kind of that big middle ground, we believe that the broader markets can, if you will, you can discount to a certain amount the COVID-19 and what it's going to do on the economics. If we say, hey, we can open up in 3 months, 6 months, 9 months, it takes, 12 months or so to get the vaccine. We can talk about all that. But you can, if you will, through probability and statistics, kind of get to some numbers that you can talk about, get comfortable with. But the reality is the US is not the only country executing this enormous amount of stimulus. We have other countries, almost every other country, with enormous stimulus packages out there as well. And so once we move through, and we're seeing today, how do we reopen the economy? What portions of the US that have very low rates of COVID, how can they start re-engaging in their local businesses and opening back up? The stimulus that's already in the pipeline could drive our GDP back to 3 to 4+% rather quickly. So that could, like when we look at the economy in the V, W, a U, we've already seen technically a bull market to a bear market, back to a bull market, and then kind of trade off from that. But we won't really feel the effects of how we were feeling back in January, probably until the back half of this year. Because right now we're still trading in an information of how much stimulus is going to be coming, when are those checks hitting, and kind of just much more beyond our control. How are other people helping the local economies? And until we can really move back towards the companies and their earnings projections, that's going to take some time. But the other thing I want to share too, that the stimulus that we're experiencing has many layers. And one of the things that I do want to bring up, because I think it has lasting impact for not just the US, but for every other country, is that local demand sourcing has become so critical. I'm sure we've all seen various stories, how true or how not true, but definitely being in control of your destination and being in control of what may be deemed a matter of national security for us as well as for other countries, I believe is going to propel more and more industries to have local sourcing and replicative sourcing. So I'm not suggesting that everything's going to migrate back to the US, but I do believe that we're going to have more and more production for various needs that all of a sudden we become well aware of locally. And I do think that's going to occur, like I said, across many other countries. So this includes, corporations such as GM, right? They're producing ventilators, Ford ventilators, Virgin Orbit ventilators. The alcohol producers have pivoted to hand sanitizers. InBev, I mean, this is Diageo, Bacardi, Tito's, the list is on, and this is huge. They're all stepping up. Some had to be asked, but nonetheless, they're stepping up. Others obviously volunteered. And so there's a huge pivot to what do we need and how quickly can we get it out in the community. And also the most of the hand sanitizers out right there from the alcohol manufacturers going directly to the doctors and nurses before it was then being widely distributed. And then obviously on the healthcare side, you have a lot of them saying, the deductibles are going to be waived. So everybody, I guess in this instance, clearly stepping up and making sure that as a community, we're taking care of each other and we're doing the best to flatten the curve, kind of our new phrase over the last 6 weeks or so. Let's see here. What do you think the COVID bring health risks that are hard enough to quantify as our information is weak, but there is enormous uncertainty about government responses to the risks? So as I'm understanding that, I have been surprised both positively and negatively with the communication flow around COVID. So obviously as the US and various states were experiencing the cataclysmic rise in patients, we definitely had the benefit, if you will, of what other countries had been going through and what successes they had that we could share so that our knowledge base would just rise exponentially so that with treatments, we could continue to improve literally hour by hour and day by day so that potentially what we experienced and what other countries after us experienced would continue to flatten the curve quicker and shorten the duration of even stays in the hospital and maybe even not even going to the hospital as even the COVID morphed into other potential strands, if you will. So, as as I look at maybe what's next, I am pleasantly surprised by, I'll say France, there's 10 days of treatment for this. And after there was one study that I was reading that 96% of the viruses wouldn't grow after the treatment. So I'll just say there's an unprecedented amount of organizations working on this. I went through and I was literally trying over the course of this, the last few weeks, trying to figure out which companies, obviously, were in what stages of developing successful treatments as well as successful vaccinations. And what I was pleasantly surprised by, frankly, was that the list was endless. So there's like 70 plus treatments, vaccines currently in process, and the use, from my perspective, of efficacy within the descriptions of how far along they were in the process was also encouraging, because so many of them actually had that in there. Clearly at the FDA and other countries' processes are shortening so that we can test these out a lot quicker. Gilead's treatment continues to be very solid and hopeful. Abbott's rapid tests are shipping to US customers around the country. And I'm not sure if anybody just heard, but I had heard a whole lot of those rapid tests went down to Fisher Island. Plus or minus, there's a little scrutiny around that, but nonetheless, the list is endless with respect to Moderna working on vaccine treatments, as well as universities working on various treatments and targeting the various proteins within the COVID virus. So that has built a lot of hope, which is always good, but and especially understanding, typically it takes about 5 years for a vaccine to be developed. But based on where, I'll say collectively, the globe was as it relates to understanding this particular virus, and then being able to take that knowledge and elevate it to treatments as well as to potential vaccines, there's a lot of smart people around the globe now saying that could be available as soon as spring of 21. Right? So then that brings us to, that's great, that's awesome. In the midst of that, a lot of treatments are coming through that seem to be very positive, shortening the time on respirators, shortening even the ability to need a respirator. So all these are really good signs so that we can potentially open up a whole lot sooner. So I hope that that does answer some of the questions I've been receiving. Let's see here. There's a question here. Has there been an improvement to research technology from 2007 to now, such that people could be smart enough to go full of bear market in 1 month? I'll just say what we did see and why we were able to go from the bull market to the bear market back to the bull market was driven by a tremendous amount of volume and fear, frankly, that the fear of the liquidity crisis that I was mentioning a little while ago, the fear of the unknown of what this virus could do, would do. And then on top of that, we add in technology, which has implications in a down market as well as in an up market. But in a down market, because of some various rules, I'll say, that have been eliminated from the processes in terms of an uptick rule before you can short stuff, program trading has exacerbated various moves. So over the last year, the last month, seems like a year, we have had to suspend trading for 15 minutes because we've opened down, or during the day we hit some down triggers more than up triggers. So it's not that the intelligent quotient has changed, if you will, but what has changed are some rules and regs with respect to how that can happen and what we need to do in terms of a timeout. And also just that program trading, from that perspective, that has clearly reached new levels And I would suggest that it has been to the detriment of markets rather than to bringing efficiency really to the markets, is our thoughts. And then there is a question with respect to stimulus and if you will, where does gold play in your portfolios? And from our perspective, gold has a place in your portfolio. Not that it should all of a sudden jump into your portfolio. And I would like to I didn't actually put gold in that scenario. Should have, but anyway, I have a hypothetical scenario that I wanted to share with everybody. Just with respect to educating the audience about a portfolio, maybe a balanced portfolio, and just bringing some additional clarity to that. I didn't put in there the gold situation, but we do believe that should be an allocation of your portfolio. The suggestion here is it 10%? It really depends, which is why I'm going to jump over here to this situation, on your individual appetite and on your individual risk tolerance. So every person, every potential, whoever your advisor is, or whether you're doing it yourself, you kind of have a process, hopefully, that you go through. And this is just one of many. So I'm not touting it as the end all be all, but I do just want to walk you through some of these things. And I have this up as just a balanced portfolio, some hypothetical holdings, but what the real education point that I want to bring to the table here, and the reason for the questions, if you're just like, why is she asking me these questions? It's part of what we need to understand with respect to how risky you are. If you simply ask a person, how risk tolerant are you? They have no idea most of the time. So you need to ask some framing questions with respect to kind of their daily activities, what they really like to do, kind of what might be their favorite thing to do to try and help narrow in on what a portfolio for them might look like. So in this hypothetical scenario, I have 20% here for floating rate securities. By and large, that would be buying individual bonds, if you will. And the numbers to the left are on a scale of 1 to 100. And so you'll see some of these equity positions, where they fall with respect to that range of 1 to 100. Obviously, some that you might intuitively think, hey, they're kind of risky. You might probably hadn't thought that Disney was as risky as it is at 90. But nonetheless, these and everything, if you will, because it's a math-based process, has a number. Cash, obviously, 1, the most secure. And a blended basis gets you to a risk number of 52. What does that mean? So I did a hypothetical portfolio of $250,000, and then that would mean this particular individual was comfortable over the next 6 months or so losing 10%. That would be $25,000. And on the flip side, obviously everybody loves the upside, gaining about $51,000. So here, in this situation, we can also show you what this means hypothetically. So many people also don't know that the S&P 500 is as risky as it is. It's often used as a benchmark. Hey, did my portfolio do better or worse than the S&P 500? It would probably do better if it was more riskier than the S&P and we were in an up market. But if your portfolio, like the one I'm hypothetically positioning here, is more of a balanced approach. So in that bull market of 2013, this portfolio would be up 24%. The S&P would be up about 32%. On the flip side, obviously, a bear market like 08, it would be down 27 versus the S&P being down about 37%. So this just helps with conversations. It's not the only thing that you should be reviewing, that we would be reviewing, but it just helps, like I said, to have that conversation and to help people understand exactly what's going on in their portfolio. because you want to make sure you're investing in the right things for you. Never mind it's cocktail conversation for somebody else, because their risk tolerance most likely is completely different than yours. And then on the retirement map side, what does all this mean? So I did another hypothetical situation here, took the 250 as a base. I did a monthly savings rate of the 1625 simply because that was from a 401k perspective. If you maxed out at 19,500, that's what it means on a monthly basis. And then this person was born in 1975. I had an annual savings increase of about 3%. And so when they went to retire, they would have about 3.2 million, and then they could successfully withdraw 16,000 a month until they were the age of 95. So that's how this portfolio works. We could clearly change this around and put 100,000 over here, and I could really monkey wrench this down to so that the success ratio here would now be only 81% and the portfolio would only grow to 2.7. So it's a nice interactive system. You can also, it throws up things like invest a little more aggressively, like you're 60, withdraw only 13.8, retire obviously a little later, and then save a little more or withdraw even a little less. So these are just some helpful tools that I wanted to share with all of you. There are many out there. So, but it just, like I said, encourages great conversation. I'm going to jump back over here and see if there are some more questions here. Should we be prepared to pay more for products once they are manufactured in the US? Absolutely. And frankly, I was having that conversation with my family recently, because for so long, a lot of things obviously migrated around the world, and I'm absolutely fantastic with a global economy and multiple sourcings coming from every different direction. But I do think we need to be prepared for what that means. Frankly, it also means more jobs and different jobs and a plethora of more jobs domestically. So I would be careful not to infer that simply that migration to the US, because like I said, I think it would only be one of multiple locations in which many companies are going to be sourcing their supply chain. It has ramifications for GDP growth, as well as potentially inflation, if you will, in terms of paying more for the products. But I can see kind of a well-rounded approach to what the next iteration is here, and bringing things back on. I have heard stories, it's taking too long to get different sources. We can't get them. They're also impaired in some ways, so they had to go back, and it disrupted supply chains. So I think all of that has issues for any business. And then going back to kind of reopening, what happens here? Germany announced this morning that they're going to be reopening some sections of their economy beginning Monday. Also, I have heard of some states opening up some businesses, but a general comment was that many of the local geographies are looking with how to open and what to open first, and considering temperature monitoring and facial protection in order to get people back on the job. People want to work, they want to be out there, they want to be engaged in the community. And right now, I did hear 29 states have low enough infection rates to begin reopening. So that was just announced about an hour ago. And then even last week, Disney was out with commentary with how to monitor body temperatures to engage their parks and reopen the parks. Cinemark was out just a little while ago saying they're going to start reopening in June. So they're talking about obviously staggering what seats that can be taken. So obviously it'll be a whole different structure with respect to what the seating looks like. But nonetheless, the other interesting collaboration was announced late last week. Apple and Google working together to try and help with the reopening. It's an opt-in, at least the data that I've seen so far, consent to clear and cooperation with the public. So you would be anonymously, which I'm always loosely defined anonymously, you would say, hey, I've been tested, I'm fine, and it would all be anonymous. But if you signed on to this potential app, I'll call it, you would know if somebody else that you encountered, I'll just use Publix as an example, you went into Publix and then over the next 3 days, this system would alert you that somebody that was there may have tested positive for it, then you would know just to go get the test, not that you have it. So those are the types of networks that are starting to be discussed, collaborated on. Obviously, along with this, there's a whole privacy issue that needs to be addressed. And I would imagine there's going to be a balancing act between how quickly do we want to re-engage our economies? How quickly do we want to get back to work? And I say do we because we know we need to. So it's really not a do we, it's just how quickly it happens and what we might be sacrificing with respect to information and sharing that information. It's almost like kind of your neighborhood watch on steroids. And so those are some, I think, really good signs with respect to how and when we're going to be reopened, because it's starting to happen, and that is a huge positive. The other things I've been seeing too in terms of what is kind of priority, running factories and construction, not that construction really ever died down, but it probably slowed a little bit, right? And then schools in the first phase of reopening. And then the large sporting events would likely not come for some time. With that being said, I was surprised with Cinemark, not that it's a large sporting event, but it might just give us some test ground for how to reopen and how comfortable people are going back into, I won't say large locations with a lot of people, but I think those are going to be good things that we can learn from with respect to how then to open on a bigger scale. I'm just going to go back in here. The checks are barely going to help people. So the interesting thing, and this is anecdotal at best, but I have heard a lot of anecdotal information depending upon the various checks that are going to people that have been laid off or furloughed, right? There's a combination of things going on here. Companies were to be applying for the PPP program in order to keep people on payroll, and those loans would then be forgiven. So then you're hopefully, I'll just say, close to your existing salary, or maybe you took a slight pay cut, but you're not going to apply for unemployment, if you will. So it's better than that. And then the checks that are going out to everybody, no, they're there to help and support, but it's supposed to be to augment the other supply chains that are getting out there with funding for the individuals and the small businesses. In some instances, I've seen and heard that some people actually wanted to be furloughed because the amount of money they were going to be making outside of that was technically higher. That was some of the battleground that was happening before the CARES Act was passed, because there are clearly some anomalies. It's not perfect, but I can assure you, based on during the 2008 time period, we were financial agents for the U.S. Treasury Department. So I have a knowledge base and a pipeline of information, if you will. But they're doing as much as they can, as quickly as they can. And there's more there, right? We do know over the next few days, they're going to be coming through with a larger pipeline. The current plan for the small businesses is set to exhaust this Friday, the 17th. So that funding base needs to be expanded. But on top of that, many of our elected officials are rightfully concerned that there are other areas of the economy that need help as well. So they're looking to make this next bill a much larger component. I don't know if we have that kind of time. So there's a ton of banks that are doing a yeoman's job of getting all of these requests in as quickly as possible and turning that around. But frankly, it's going to hit the wall unless we have that entire basket of funding elevated sooner rather than later. So that's going to happen. It's just a matter of how political it's going to get in the near term. But I do expect that to occur before we run out, or maybe, you know, they'll keep us all waiting on pins and needles and then kind of do it at the very last second. The other thing I do want to mention is that, you know, the scale of the response to this virus is unprecedented. I mentioned there's 70 plus institutions working in some form or fashion on either treatments or the virus itself. You know, it's the Manhattan Project on steroids. And the other thing I've learned, I've been in the investment business for many years, and you don't bet against the Fed, and you don't bet against America. So I just have to say that we are in tough times, and if you have the wherewithal to, you know, look at some investments in this market or just continue to invest, whether it's through your 401k plan or if you have an IRA, you invest in that on a regular basis. And over time, especially if we look back over the next year, I think you're going to be pleasantly surprised at how quickly the turnaround occurs. Simply because I look at two things. I look at a list. I do have to do my positives and negatives. Like I said, there's just unprecedented stimulus. So then once we do get through all this, we will have to deal with inflation. I do not think it's going to be like the inflation that we battled as a country in the late 70s, early 80s. We were pushing, you know, right now Fed funds is at 0. Fed funds at that point was like at 16%. It was just ridiculous. But yes, there are ramifications to, you know, the printing press running on full speed. However, with that, you know, you kind of look at two things, at least when you're looking at that inflation. That typically means your GDP is huge too. So it's not just 3 or 4% if you're going to have inflation at 6 or 8. So there are a lot of different factors that run at play here. And so, yes, we will have to deal with that next iteration. I feel quite comfortable knowing that we can get through that period of time. This is unprecedented. Dealing with a global health scare just is, and everybody kind of just shutting down is unprecedented. So I'm just trying to take a look here at another. Is it too late to get in now? So no, it's not. We're off the lows, we're off the highs in terms of the pullback. We, you know, and I'm sure whoever you might talk to, don't try and time the bottom. You know, technically March 23rd was the low that we hit. All evidence would suggest, based on the data that's going to be coming out, that we have a likely opportunity to test the lows again, but it's so data dependent. That would be statistically correct. And we are running out of time here, so I do want to thank everybody, but just look to measure in. I think the question here is leg in. That is the phrase. Step in a little at a time. Don't try and time the market, and invest in what you know and what you're comfortable with. Don't ever step too far where you can't explain your investment. Okay, another question is, what do you think the housing market will, how do you think the housing market will be affected over the next 1 to 2 years? Great question. So even today, the numbers came out, and I'll just say purchases are just dropped off a cliff. But on the flip side of that, obviously, refinance activity has just completely exploded to the upside. So over the next 1 to 2 years, the housing market should stabilize and continue on its path. And the reason I say that is because once the economy continues to resume a more normalized expansion. People will be moving around the country. People will be looking to upsize, downsize, and I'll just say for the foreseeable future, I'll give it a year to 2 years, we'll continue to have relatively low rates. The housing market does feel pressure when obviously rates start to march higher. And if and when, I'll say, we're battling with some sort of inflationary environment, much better than the deflation environment that we've experienced from time to time over the last 15 years, we can manage through that process. So, so I'm confident in the housing market. The other thing too, which is the backbone of all of this, the banks, small banks, large banks, they have fortress balance sheets going into this crisis. They are there for all of their clients. They're there for some clients that weren't their clients, trying to facilitate the payment system. And some of the numbers, because they're all reporting this week, they're building their reserve positions because we do know we're going to have credit problems. That's going to be happening, but they have very strong reserves to weather this storm. So that won't be the next issue, which then obviously also supports the housing market. So I know we're wrapping up on time. I do want to, and as somebody says, there's super excellent rates for mortgages, and that is entirely true. I want to thank everybody for their time this afternoon. And if you have any other questions that either I missed or I didn't get to, or I kind of misunderstood exactly what you were trying to communicate, don't hesitate to reach out to me directly. And thank you again, and have a wonderful day and stay safe.
Thank you so much, Jackie. We greatly appreciate your time, and all your education and information is just insane for me. I'm like, oh my gosh, it's so much information. So thank you again for being here with us today. This presentation has been recorded, so you will be able to see this presentation again on our YouTube playlist. And we'll also send you an email with the link to Jackie's presentation as well as the video. So thank you again, Jackie. Thank you all for being here with us today. We greatly appreciate your time. Any questions, like Jackie said, you can shoot them over to her. We'll give you her contact information in the email, or you can shoot them to me and Sophia. We'll shoot them over to her. A lot of shoot words over here. Sorry about that. Anyways, thank you so much for being here. We hope to see you in the next virtual presentation brought to you by the Boca Chamber. So stay safe, stay healthy, and have a great day.
Thank you.
Thank you.